we got to talk about today. All right. So we're talking about getting approved, which means that we're talking about how mortgage products and programs actually work and how they're structured. So the first thing you need to know are some key terms. Okay. Some key terms. And those three most important terms when you're talking about a mortgage is the principal payment, the interest, and amortization. Okay? Amortization. So the principal payment is the actual payment that goes towards paying the amount that you owe. Okay? Interest is the annual interest rate, which is dictated by your credit score. We talked about that yesterday, your credit score, right? Divided by the number of compounding periods, which equals your periodic interest. Okay? So I'm teaching you these words so that you, when you see them on your loan documents, you're not like, what the F is that? Okay? Are they trying to get me? No. So your interest rate, the actual formula for it is they take your annual interest rate, which is determined by your credit score, divided by however long you have the loan, and that equals your periodic interest. All right. Now, amortization, okay? Amortization, I'm saying it over and over again so you know how to pronounce it. Amortization is when a payment covers the amount of interest being accrued plus an additional amount towards the principal balance of the loan. Okay. Now you can have positive amortization, which is regular amortization, or you can have negative amortization, which means that it goes in the opposite direction. Okay. And if you have negative amortization, typically that means that at the end of the loan, you're going to have a significant amount that you owe in one payment, like one lump sum. And that's actually how a lot of people got caught out there in 2008. Their loans became due because they were negative amortized and they was in hot water. All right. Fixed rate mortgage. Okay. A fixed rate mortgage is a mortgage with a fixed interest rate over the term of the loan. Okay. This is the typical kind of loan that you go to the mortgage folks to get. Okay. This is when you think about mortgages, most of the time you're thinking about a fixed rate mortgage. Okay. It means that you have fixed terms of 10 years. Most people don't know. They're like, oh, mortgages means that I have to be stuck in here for 30 years. That is not true. You can have 10-year term, 15-year term, 20 years, 25 years, and 30 years. 30 years is just the max, okay? Now, most people do 30 years because the shorter the amount of the term, the more your monthly payment is. And sometimes it is stifling for people, right? So they're like, hey, I might be, finished with this loan in 10 years, but if my loan is $800,000 and on a 30-year mortgage, I'm paying $5,000, then that means that on a 10-year mortgage, I'm paying like $10,000. I'm paying like $10,000 a month. It's crazy, okay? So most of the time, the traditional term is 30 years. Only time it changes is if taxes and insurance increase or your mortgage insurance is removed, okay? This is also affected by inflation, and generally or typically it is put in what is called an escrow account. An escrow account is set up by a third party, typically the titling company, so that all your monies goes into there and then they pay out whoever it is, which is the lender for the mortgage, the IRS for your taxes, and whoever you choose for your homeowner's insurance, they pay your homeowner's insurance for you as well. That is if you get it in an escrow account. Typically it is. Sometimes it may not. Sometimes the lender might be like, yo, it's up to you to pay all your bills. Okay? All right. So when you have a monthly escrowed mortgage, this is how they come out with the entire payment, okay? You have to pay taxes, you have to pay insurance, and you have to pay the actual mortgage principal amount, right? The amount you owe to the lender. And then they divide it by 12. And that's what your monthly mortgage, your monthly escrowed mortgage is. Okay? So typically you're paying for 3 things in one. So when people say, hey, you should pay extra on your mortgage so that you can pay it down fast, what they really mean to say is you need to pay extra towards your principal amount, because that is the amount you actually owe. Okay? Now also in here is your interest as well. Give me some thumbs up in the chats if you got it. Give me some thumbs up in the chats if you got it, got it, got it. Let me know if you got it, okay? Let me know, let me know. It's Friday. I'm going to start singing to y'all. It's Friday. I'm going to start singing to y'all today. Okay, cool. I see some guidance coming through. Awesome. Fantastic. All right. Now, you may see what is called an adjustable rate mortgage also, okay? Now, this is a mortgage where the interest rate periodically adjusts, okay? So the adjustment is determined by the index, margin, and adjustment caps. Now, you don't really need to know all of those technical terms, but just know that that is what goes into an adjustable rate mortgage. So you usually start with an initial rate and payment that remains in effect for a limited time, ranging from 1 month to several years, and then it changes, okay? With most ARMs, okay, so if a lender is like, yeah, we were looking at an ARM for you, this is what they're talking about. Adjustable rate mortgage. Short-term ARM, okay? Or AKA ARM. Or it could also be called a variable rate mortgage, okay? It could also be called a variable rate mortgage. So don't get tripped up on their tricky terminology, okay? Make sure that you understand that all 3 of these things equal the same type of loan, all right? With most ARMs, the interest rate and monthly payment can change every month, quarter, year, 3 years, or 5 years. Okay? So the period between rate changes is what is called the adjustment period. Okay? Most of the times you'll see an investor, and I would say like a very savvy investor, getting into an adjustable rate mortgage. But you, as getting just a regular home for the purposes of rental income, do not need to get an ARM, okay, in order for you to use it as rental income, okay? You can use a traditional mortgage, okay? You can use a traditional fixed rate mortgage, okay? All right, thumbs up in the chat if you guys understand. So once you get your first property, your first rental property, and you're feeling really good, feeling really great, and you want to tap the equity in that property and go and get an adjustable rate mortgage so that you can, be in and out of a mortgage, definitely go for it. But for your first one, just know you do not need an ARM in order for you to get a rental income property, okay? All right. I see some guidance in the chat. Cool. All right. So there's a couple of different types. So you could have a hybrid ARM, okay, which is a mix between a fixed rate and an adjusted rate. So then they went and said, okay, well, how can we make it a little bit more appealing? And they came out with this, demon child, okay? Just kidding. They came out with a mix between a fixed rate and adjustable rate, and they created the hybrid ARM. Okay, so this means that it is interest only. So the borrower pays interest only for a 3 to 10 years, okay, term, for a 3 to 10 year term, which results in a smaller monthly payment for that period, right? So for that 3 to 10 year term, it's a very low monthly payment. And you have a couple of payment options: interest only each month. You could do a minimum payment, which can be less than the interest only, but that causes negative amortization. So at the end of that loan, you will have a balloon payment like Christy asked, right? And then you can also do what is called a combined P, M as in Mary, T as in Tom, combined PMT, which means that it is interest and payment towards the principal. Okay? Of course, she asked me the question. Hold on. Will an ARM allow you to pay mortgage off quicker? No, not necessarily. It's just that the ARM is it's just that the ARM allows you space to breathe, really. That's what it is. It's not like one is faster than the other. So, okay. So I think that question is coming from the idea that we think just because we have a 30-year mortgage means that we have to take 30 years to pay it off. That's not what terms mean. Okay? So if you are given a mortgage or even a loan, you don't have to wait out the entire time. If you want to pay that mortgage off early, you can pay it off early. So back in the days, you used to get what's called a prepayment penalty, okay? So when you're going to a lender or a bank, you just want to make sure that in writing somewhere, it says that you don't have a prepayment penalty, okay? Most of the time now in modern times, there is no prepayment penalty. They don't give a crap. Pay them back their money. Okay, but make sure that it's actually written in the verbiage, but you don't have to take 30 years to pay it off. So let's say you get a 30-year mortgage, right? And you're like, okay, for the first 5 years, I'm going to sit on this mortgage exactly the way that it's structured. But in year 6, I'm going to go hard in the paint and get it cleared in the next 3 years because I have enough rental income, message, to actually pay it off faster. Okay. And that's great because then, you only took about 10 years to clear off that mortgage. And now your property, your rental property is straight profit. Okay. I mean, minus whatever other maintenance expenses that you have. And of course, those property taxes, make sure you pay your property taxes. Just because you don't have a mortgage doesn't mean you don't have to pay property taxes. Okay. And your insurance. Okay. But you won't have to pay for that monthly big mortgage anymore. So yeah, I hope that answered your question. All right. But one type of loan doesn't necessarily mean that one is faster than the other. Okay. It's just that a traditional fixed rate mortgage doesn't move. It is the same throughout. An adjustable rate mortgage means that it can move each month. It can move each quarter. It can move each year. And honestly, that would give me anxiety. I'm not even going to hold you. Okay. If I decide I want to pay it off faster, then let me make that decision. But with an adjustable rate mortgage, you're not making that decision. The lender is making that decision for you. They are adjusting the mortgage. Okay. So Christy, give me a thumbs up or got it if I answered that question for you. I want to make sure that I got your question answered for you. What's up, Instagram fam? What's up, Instagram fam? Get in here. Type bootcamp in the comments. Okay, so Christy asked, so what is the benefit of an ARM? The benefit of an ARM is if you're an investor, right? And you just want to pay it off, you just want to pay whatever that adjustable rate is as it goes, and then you just want to pay in one lump sum and get that done, then you can. But what I'm saying is one does not necessitate speed of the other, okay? It's really about your strategy. So this is a strategic question, and I can't say, yes, go with the ARM because it's faster. It really depends on how did you get into the property? What are you doing with the property? How much is the ARM adjusting by? right? Because like I said, it could adjust every month. It could adjust every quarter. It could adjust. There's so many ways that it can adjust, right? Yearly, 3 years, every 5 years, every 10 years, right? So it really depends on your strategy going into the loan. That's the difference between an ARM and a fixed rate mortgage. So the fixed rate, it is what it is. With an ARM, you can play around with strategy and paying it off. But like I said, with the ARM, you don't make the decision of how you do the strategy. The lender does. I don't know about you, but I got control issues. I want control of all my monies. All right. She said, got it. Cool. All right. So then they said, yeah, let's come out with this hybrid thing that is a mix between a fixed rate and an adjusted rate. Man, I was like, bruh, who the heck wants to do all this? Just give me the traditional one and I'll figure out how I want to pay it off. Like if I want to make myself a debt payoff plan that is aggressive for the first 2 years. Hey, Taquita, what's up? If I want to make an aggressive payoff for the first 5 years, for 7 years, and get my 30-year mortgage paid off in 7 years, let me make that decision. Okay? All right. So that's the 3 different types. Okay. And then there are 2 parts to the interest rate. Okay. So there's something that's called the index percentage and there's something that's called the margin percentage. Okay. So the index is a measure of market interest rates. So it fluctuates with the market. Okay. The index fluctuates with the market. And if you're into life insurance, this actually is going to make a crap ton of sense because in an index, it does the same thing, right? Yeah, Taquita said, hey, everyone. All right, it fluctuates as well, right? So while the margin is the profit, is in profit, the lender adds and is assigned at the loan origin. So it stays the same, okay? So basically, while the margin has profit, right? The loan origination stays the same, okay? At the time of an adjustment, the lender will add the current index number, which depends on the loan's assigned index, plus the margin, okay? Now, this is talking about ARMs and the hybrid ARM, not the traditional fixed rate, okay? So getting a little bit more into the weeds, Christy. All right, so some ARMs also have interest rate caps, adjustment caps, so that they don't adjust like crazy. Like tomorrow, you worried about your ARM being a different way. This is so that the interest rate doesn't go past a certain percentage every time it adjusts, right? Because the percentage is really gonna be determined by, it is never cool enough in here. It's really gonna be determined by that interest rate, okay? So, is an ARM better than a fixed rate? Hold on. Let me see if I can scoop myself out the way. No, I just scooted myself closer in the way. Hold on. I'm going to scoop myself. Hold on, y'all. All right. Now I'm in the middle. Okay. So is an ARM better than a fixed rate? Okay. So this is really going to depend on 4 different things, right? So it's going to depend on your income. Is your income high enough or likely to raise enough to cover the higher mortgage payments if the interest rates go up? Because every time those interest rates goes up, that means that payment goes up. It gets higher and higher and higher, okay? Debt. Will you be taking on any other larger loans? Okay. Are you thinking about getting a student loan? Are you thinking about getting an auto loan? Are you thinking about getting a business loan? This loan will stop you in your tracks because you don't know what your expendable income is going to look like the next time this mortgage adjusts. Okay. Residency. How long do you plan to live in the home? ARMs are really supposed to be used for investors, to be honest, okay? Someone that is coming into a property and coming immediately back out, okay? Because you don't want to sit in something that is so unstable with the way that it adjusts, okay? Payment. Do you plan to pay off your mortgage early? Now, again, this really depends on your strategy, which is why we took 10 days just to focus on home buying strategies, right? So that you could understand when we got to this point, should I use this type of loan or should I not? Okay. All right. Thumbs up, thumbs down, thumbs sideways. What are we doing? We got it. We got it. Hello. Hello, Instagram fam. Whew. It is like the devil's breath in Florida right now. Jeez. AC ain't doing squat, y'all. Got it, got it, got it. Questions. Okay, Jenny said, yes, got it. Okay. Cool. Flavia said, got it. Okay, cool. And Christy, we really do need to reschedule your wallet wellness exam. So if you want to talk about ARMs at that point, we definitely can get a little bit more into the weeds about it. But to be honest, if you're not going to be like a flipper or a whole, if you're not going to be a flipper, I wouldn't suggest an ARM. Okay. And really what I teach is ownership. I just present this to you so that you know the difference and you don't get caught out there getting an ARM when what you really wanted was a fixed rate. Jenny said, I guess it's hot everywhere. Girl, it is. It's baking in here. Okay. It's like the AC ain't doing squat. Whew. Okay. Christy said, okay, great. Taquita said it was ASL. What's that ASL? For like 2 days. What's that? What's that mean? Listen. All right, Gen Zer. I don't know what that means. What does that mean? Okay. As hell. Okay. I was like, what's that? Okay. Now, these are the programs, okay? So your loan could be a conforming loan. It could be a non-conforming loan, or you could assume someone's loan, okay? So a conforming loan is a mortgage that conforms with Fannie Mae and Freddie Mac guidelines, specifically with the loan limit set by them annually, okay? And we went through, was it yesterday when we were talking about, no, the day before. So it was when we were talking about your consumer rights and how the mortgage industry was created. Remember that tree, Freddie Mac and Fannie Mae, not to be confused with Sally Mae, who's ruining everyone's lives with student loans. Okay. Yeah. All right. So that a conforming loan goes along with those guidelines. All right. A non-conforming loan does not conform to Fannie Mae and Freddie Mac guidelines. It's just that simple. One does, one doesn't. Conforming, non-conforming. Okay. And then assumption allows for a borrower to assume a current mortgage, generally with little to no change in the terms. And this is super cool because this means that you can literally take over a family member's loan and not have to buy or I mean, I wouldn't do this. I wouldn't do this with anyone that like I don't actually know, because like I don't know about just assuming a stranger's mortgage, but it's really cool because that means, like, for example, if my grandmother hadn't have taken out that reverse mortgage and she just had a regular traditional fixed rate mortgage on there, I could have been like, hey, grandma, I'll take over the payments from here. You go rest. It's okay. And the loan would literally transfer from her to me without changing the loan and without me having to go and qualify myself. Make sense? Thumbs up. Thumbs up, thumbs up, thumbs up. Thumbs down, thumbs sideways. Did we get it? Do we got it? Do we get it? Do we got it? I told you I'm might be singing today. It's Friday. It's Friday. It's Friday. It's Friday, and we're ready to sing. Pick up my girls and... No? Oh, okay, Taquita said, got it. All right, cool. I see some got it's in the chats. That's what I'll be waiting for. Now, this is not to be confused with signing over a deed, okay? Because just because you sign over, you assume a loan, does not mean that you are on the deed. You have to do both, okay? And if you're on the deed, that does not necessarily mean that you have assumed the loan and you are responsible for it, okay? Just because you're on a deed doesn't mean you're responsible for that money, okay? Your name ain't on that loan, all right? Okay? Christy said, hey. Oh, you doing that for my singing? Hey. Jenny said, makes a lot of sense. Oh, awesome. All right. I thought we was going to get stuck today. We doing pretty good today. I'm feeling it. I'm good. Good, guys. I'm glad I warmed y'all up to this part. You can't just be throwing terms out at people immediately. That's why I was like, let me guys slowly progress to this so that by the time we get here, it makes some kind of sense. Yay. All right. Now, we're going to talk about some things if something goes wrong with the bankruptcy. So these are other terms affect your approvability, okay? These key terms affect your approvability, all right? So the first one is bankruptcy, okay? I gotta take a deep breath on the bankruptcy one. Let me make sure that the Instagram fam, we don't lose y'all. Let me plug y'all in. Okay. So the three key terms that affect your approvability is bankruptcy, debt to income ratio, also known as the DTI. So if your lender or your realtor asks you, oh, what's your DTI? Debt to income ratio, okay? And then the third part is loan to value, okay? Which short-termed, aka LT is in Tom, V is in Victor, LTV, okay? So bankruptcy is when a person legally declares they're unable to pay their debts. Now, let me ask you this question, because y'all in here know that banks are businesses, right? We know that banks are businesses. So if somebody comes to your place of business and says, hey, can I have that shirt? Okay. But you done told Sally over there in Old Navy that you can't buy her, you owe her for her shirt, and you come over to my shop and you trying to get my shirt. Do you think I'm going to loan you the shirt? I ain't loaning you diddly squat, because you just told me that you can't pay Sally over there. And you took money from Sally, and then you legally declared that you can't do nothing. You can't pay nothing. All right. Now, of course, there are forgivable moments. Okay. So they don't hold it against you forever. But if you just got a bankruptcy, don't be rolling up in somebody's credit card company, somebody's store, somebody's bank, like, hey, can I have some more money? And I don't care what any of those internet influencers say, your personal still affects your business credit, okay? So even if you declared bankruptcy on your personal and you go and try to be like, well, I'll go get it on my business thing, you are still screwed, my friend, okay? Because some banks do want you to personally guarantee unless you have built your business credit the correct way, only on your EIN, which most of us don't because we don't really understand how business credit works. But that's for a separate day, all right? So bankruptcy. Now, the next term is debt to income ratio, your DTI. This is a calculation to determine whether the borrower can pay the mortgage, okay? So how much debt do you have compared to your income? How much money are you bringing in compared to the money coming out? Sounds like a budget, don't it? Sounds a little bit like a budget, kind of, sort of, okay? But Loan to value. So loan to value are programs that require borrowers to put a specific amount down or have a specific amount of equity in their property to obtain a loan. Okay? Now, I want to scoot back just a little bit because I ran through them, but let's go back to bankruptcy. So bankruptcy has a chapter 7 and a chapter 13. Okay, so a chapter 7 is a complete liquidation of all debts. Okay, a complete liquidation of all debts, which means they all go poof, but those lenders still, have a loss to deal with. Okay, chapter 13 allows the debtor to pay back their lenders through a payment plan that is declared by the court. So you're not. Chapter 13 allows you to keep those accounts open, keep those relationships open, and just say, hey, I need you, court, because they trying to make me pay $600 and something a month, and I make $200 and I can't afford that. Can I pay them $10 a month? Something like that's a little dramatic, but you get the point, right? Whereas a chapter 7 literally destroys your banking relationships, because you're saying, I don't got it and I don't want to figure it out and I don't want to pay you anything. Okay? All right, DTI. So your DTI, or your debt to income ratio, is calculated in 2 different ways. Okay? One is called a front end and the other one is called a back end. Okay? So the front end is calculated by the amount that the borrower will be paying for their mortgage divided by your gross income. Okay? So the front end is the amount that you will be paying for your mortgage divided by your gross income. Remember, we talked about this yesterday. The lender is looking at your gross, not your net, but you know that you don't gross. You don't make all that monies. Okay? Or at least you don't get all those monies. You make all the monies, but you don't get all of it, okay? Back end, okay? So back end is calculated by all of your monthly liabilities divided by your gross monthly income, okay? Now, which DTI is better? I am going to say back end, okay? You want your lender calculating your back end. All right, because then that means that each and every month you have the potential to be like, bruh, I'm paying off that debt. So can you still approve me for the loan for this amount? Because by the time we're done closing, I'm going to be done with this one and it doesn't count anymore. They will do that. They will help you through. When I first went to my lender, I wasn't completely finished paying off my debt. I still had I think I had a card or 2 still to pay off. And I was like, I'm going to just keep paying this off while you're doing the loan. And then when we're ready to actually close, then we can recalculate my DTI, right? And they were like, yeah, absolutely, we can. Keep paying it off. So remember yesterday I said it's okay to pay off your debt. It's not okay to increase your debt, okay? But you want them calculating that back end. Not like you could, force them to, but you typically they do the back end. They do the monthly. All right, LTV. LTV is calculated by the loan amount divided by either the borrower's purchase price or the property's appraised value, whichever is lower, okay? Whichever is lower. And I'm giving you all these key terms because we're about to get into the actual conventional loan, FHA loan, and I'm going to run through the comparison and you're going to need to know what these words mean because they're all in the comparison. Okay? So thumbs up if you got bankruptcy, DTI, and LTV. Got it? Good. Can we get to the last set of key terms? Got it good? Got it good? Thumbs up. Got it good, got it good, got it good. Got it good, got it good, got it good. What's up, Instagram fam? I need y'all to get in here. I need y'all to stop playing with me and get in here. Type boot camp and get in here. Get in here. All right. I see some thumbs up. I see some got it. I see some got it goods. All right, cool. Let's move on. So the last three, all right, the last three key terms we have here is some that you may already know. Okay, so the first one is down payment. Everybody and their mother knows about a down payment in a mortgage, right? When you're going for a mortgage. A down payment is a portion of the price of the home that the borrower must pay. Okay, you got to pay that up front. Loan limit is a calculation to determine whether the borrower can pay the mortgage. Okay, so the loan limit is a calculation to determine whether the borrower can pay the mortgage. All right. And then the last one is something that we talked about yesterday when we talked about community love with the funnel of free money, which is what is called a seller's concession. Okay, a seller's concession. So this is, oh, there's a typo in there. This is the closing cost that the seller or lender are paying. Okay, it is called a seller's concession or a lender's concession. So seller's concession, the closing cost that the seller or lender is willing to pay for you. But don't be out here just being greedy with life, okay? Because that stuff comes back to you, okay? The people got families and stuff to feed too, okay? All right, got it good? We got it good? I'm about to run into these comparisons for these loans because we got about 40 minutes left. All right? Got it? Got it. Thumbs up. Thumbs up. Thumbs up. Thumbs up. What's up, Kim J? What's up? What you doing over here in the nosebleeds? You should be on the actual, you should be in here. You gotta be in here. Type boot camp in the chat and get in here. Y'all ain't type it yet. I ain't see no got it's. I ain't see no thumbs ups. Where's the thumbs? Where's the got it's? We good? We got questions. Are you typing questions? Oh, okay. So Rita said, got it. Okay. Cool. All right. So the first loan that we are going to go over is so teeny. Can you guys see that? Oh, Jenny said, got it. Taquita said we recovering from the heat waves, right? Like, shoot, it is hot. And that is tiny. Okay. Hold on. Let me see if I can scoot it. Ooh, yeah. Okay. I don't know if, oh, there we go. All right. Let's scoot in. Okay. So the first loan that we're going to go over for program qualifications is the conventional loan, okay? This is the conventional loan, all right? So for a conventional loan, they're going to be looking at, hold on. 1, 2, 3, 4, 5. So there are 5 components that they're going to be looking at, okay? They're going to be looking at your income, debt, what funds you got, the actual property itself, and then what they can do with the actual loan, okay? So let's scoot back up here. Let me make sure y'all can see it. Okay, conventional. So for your income, you are going to need to show proof of 2 years employment history. Now, recently, I talked to some lenders, okay, because there's like a lenders network, and I communicate with those people because I need to know. I need to stay up on the good stuff. Apparently, if you transfer from, I don't know, this was always the case, but it had to be within the same industry. So if you get a new job and it's in the same industry, they'll still take your 2 years of employment history. Now, try your very hardest not to change anything while you're in the actual process. Like while you're getting approved, try very hard not to change your income. Okay? Because some lenders may let you skate. Some lenders may be like, nah, you're unstable, get out. We're not giving you any loan. Okay? It's at the lender's discretion. Okay? With a conventional loan, there is no income limit. So however much you make, they're going to give you this amazing loan. Okay? Debt. You need 28 to 35% debt to income ratio. Okay? And this is back end. So that means that they're dividing your monthly liabilities by your monthly gross income. Okay? So you need 28 to 35% DTI, 45% for certain circumstances. You need at the very least a 640 FICO score. 640 FICO score. Now, these are pre-pandemic. Okay? So post-pandemic, they may be looking for a 650 at the least to a 680 at the least. Okay? You need 4 years from filing a Chapter 7 bankruptcy or 2 years from a discharge or 4 years from dismissal for a Chapter 13 bankruptcy. Okay. So if you have a Chapter 7 bankruptcy, you need it 4 years from the filing. If you have a Chapter 13 bankruptcy, it's either 2 years from discharge or 4 years from dismissal. Okay? 7 years from foreclosure, you can then reapply for a conventional loan. And 4 years from what is called a short sale. We will not talk about short sales here today. That is like crisis mode. So we're not talking about crisis mode. All right. 4 years from a short sale is when you can go and do another conventional loan. Okay. For the funds, you need 2 to 4 months of what is called a PITI reserve. PITI reserve. Okay. Which stands for principal, interest, taxes, insurance. And I am actually going to put that on the board. I don't know if you probably won't be able to see it after I put this back up, but at the very least, PITI, okay? So PITI is principal, all right, interest, taxes. Remember I said how important your taxes are? Insurance. Okay? All right. Yes, your taxes need to be filed correctly, but this means that you're going to actually pay them taxes. Okay? So you have to have enough for your PITI, 2 to 4 months reserves of the principal, which is the amount that you're going to owe on the actual mortgage itself, your interest, which is going to go to the lender. This is basically a payment to the lender for borrowing their money. Taxes, which of course we know is good old Uncle Sam. And then insurance, which is going to go to an actual insurance company, whoever that you actually want to get your home insurance with. It could be anybody. It could be Liberty Mutual. It could be Geico. It could be State Farm, whoever. Insurance. Okay? So you need 2 to 4 months PITI reserves. Now, you can't borrow money. You cannot borrow money for your down payment, as that would affect your debt to income ratio. However, you can use gifted funds. Okay? And let me put this back up here. You can use gifted funds. Okay? So your down payment for a conventional will typically be a 3% down payment. A what? 3% down payment. So for everybody who thinks you got to come up with $20,000 for a down payment, I don't know where people got that number from. 3% down payment, okay, for a conventional loan. Now, you can receive gifts for a conventional loan. It can be from a blood relative, but they cannot expect to be paid back, and they actually have to create or write what is called like a gift letter, and they have to sign and notarize it, and then you can use that money with the lender. Okay. Property. So the property has to have 97% loan to value. Okay. 85% if you're doing an a cash out refi. We're all home buyers here, so you guys don't have to worry about that number. But 97% loan to value LTV. Okay? Which means that the loan can cover 97% of the value of that property. That's what LTV really means. Okay? It can cover 97%, which means that you have to come up with what? How much do you have to come up with? If it's 97% that they're covering, how much do you have to come up with? The rest of the actual loan. 3. But y'all got it in the chat? Y'all got it in the chat? Hey. Oh, what's up? What's up? 3%. Exactly. Thank you. So now you know where that 3% down payment comes from. Now you know it is not a mysterious number. Okay. It's to fill in the gap because they're not going to cover 3% of that loan. Okay. Now you will have an appraisal required. Okay. You will have to do an appraisal. And that's just really, let me scoot myself out the way here. That's just really an appraiser coming in and saying, hey, this property is this valued at this amount, right? And I think we talk about that. Did we talk about appraisal at all? Yeah, we'll talk about appraisal towards the end. So in like a couple of days, we'll talk about appraisal. Okay, loan. So the actual loan will have a loan limit, and this may have increased because I think that this is an older presentation, but it has a loan limit of $548,250. Okay. It may have increased since this was actually printed or created. So my bad, but yeah, because this was like, I think this was last year. Last year I created this presentation and I was teaching it. So it may have increased this year, all right? It is not assumable. You cannot assume a conventional loan, okay? You cannot assume a conventional loan. There is a PMI on loans with less than 20% down payment. Okay, and PMI is private mortgage insurance. That is so just in case you default, they have insurance to cover you. Okay. So if you put down less than 20%, you will have to pay a PMI. You can pay off that PMI. Okay. You can pay it up in full, or you can pay it off a couple of months after you get the actual mortgage, but you don't have to like keep it on the loan. Okay. But once the LTV reaches over 80%, it'll fall off by itself. Okay. Non-occupying co-borrower not allowed. So you cannot have somebody who is not your co-borrower inside of that house. Okay. Non-occupying co-borrower not allowed. No owner occupancy requirement. So you don't actually have to live in this property. What? So if I go and I pay 3% down on a conventional loan, I can go continue sleeping on mom's couch or in my childhood room or with a friend or whatever, make all my money from this rental property, take out the equity eventually in 3 to 5 years when I have it. Or if I don't want to wait that long, then, you know, you do the other option that we talked about, right? On the day that we talked about equity tapping, you get your equity out and then you go and buy yourself your primary property. Okay. Period, poo. All right. Got it. We got it. We got it. I'm moving on to that. I see some got it's coming through. I always have to wait because of that delay. I'm like, do you guys hear me or not? Okay. So now let's talk about FHA, which is the one that gets the most, talked about in these here streets. FHA. So FHA has no employment history requirement. There is no employment. They don't care. They care if you're working, obviously, but they don't care if you've been working there for 2 years, 3 years, 5 years, 2 months. They don't give a poop. Okay? No income limit. They don't care how much you make, how much you don't make, just as long as you make something to cover this here loan. Okay? Now, debt. Your debt. They are looking at a 31 to 43% DTI. Okay? 31 to 43% DTI. You can have a 580 FICO score. But that means that you would have a 3.5% down payment. And if you have between 500 to 579, it is going to be a 10% or more down payment. Now, FHA is a federally backed loan. Conventional isn't. Okay? So FHA is a federal backed loan. So they might not have scooted up the FICO score, but I always say that it is best to be in the 600s when you're going after a loan, because the interest rates will freaking crush you, okay? The principal may not crush you. The amount, the monthly regular payment, if it was just the mortgage and that's all we had to worry about, you'd be fine. But the interest rate is dictated by your FICO score, which means that if it's that low, your interest rate is going to be in the sky somewhere, okay? Ow. All right? Now, but, you guys will do what you do. Let's talk about the bankruptcy requirements and all the things, okay? 2 years from discharge from a Chapter 7, you can go after an FHA. 1 year from filing Chapter 13, you can go after an FHA. 3 years from a foreclosure, you can go after an FHA. And 3 years from a short sale, you can go after an FHA. Now, in this boot camp, we are not going to go over foreclosures, get into the intricacies of bankruptcy or short sales, but that is something that we will have classes on later on down the line, okay? You do not need a pity, okay? So you don't need this with an FHA. You should, but it is not required in order for you to get that loan. You're required to have, at the very least, a 3.5% down payment. You can do gifts, okay? You can do gifts. Oh, I do want to say, I have a couple of notes here. I want to make sure that you guys know. So the borrower must pay off all court-ordered judgments before you can actually go after an FHA or apply for an FHA. You can never have been delinquent on a student loan. This is what stops people from getting an FHA. Not the student loan itself. It's you being delinquent and not paying your bills. Okay? So you can never have been delinquent on a student loan, and you can definitely not be in default on any other type of federal debt. They don't care about the rest of the debt, the other people, them, whatever, but their debt, federal debt, you cannot be in federal debt, which means that you cannot owe the IRS. Boom. Why are taxes important? To do them right and get them all together and not be out here doing fraudulent things on your taxes? Because if you're going after an FHA loan, it is federally backed. They're going to see that you're doing things you ain't supposed to, and you're going to get arrested. Okay? Look. All right? Okay? Now, if your DTI is too high, the borrower can provide compensating factor documentation to get approved. So if your DTI is too high, you can say, hey, I'm going to have a co-borrower. They're going to come in with me. Or, hey, I'm getting gifts for this amount and all the cool things. Okay? All right. So now we're going to get down to, okay, you can have a 6% max seller's concession, right? We went over what that was today. You can have a 6% max seller's concession. Okay? Like I said, gift funds are allowed, but you can use gift funds from a relative, or you can actually use gift funds from your employer, okay, for the entire amount of the down payment, but the money must be given free and clear, and a gift letter, what I talked about before, specifying the amount with the donor's signature must be provided along with all other contact information. Okay, now this is the T. A lot of employers actually have down payment assistance programs. Ooh. A lot of your employers actually have funds set aside to help employees purchase their first home. So as long as it is a gift fund and not a loan, you can use that money for 100% of your down payment. Boom. Okay. All right. Let's go to the loan to value. So 96.50% loan to value is what they're going to cover. They're going to cover 96.50 of that property, okay? The value of that property. An appraisal is required because they need to know what the property is valued at, right? The property must be in live-in conditions. No loan will close on a dilapidated building. So you cannot go and get, a rundown building and be like, hey, FHA, I want a 3.5% down on this. Absolutely not. Okay? Absolutely not. Ooh. All right, let me scoop myself out the way again. 115% of the median. Let me scoop this up a little bit because it's teeny. If I think it's teeny, I know y'all think it's teeny. 115% of median house prices is loan limit, okay? So whatever the median in the area is, 115% of whatever that is in that area or that market that you're going in is going to be your loan limit, okay? I like percentages over actual prices because it's like, don't do me that. Okay? This loan is assumable. You can assume an FHA loan. Okay? Annual mortgage insurance is put on here. Okay? Annual mortgage insurance. I'm going to get into that in a second. 1.75% upfront mortgage insurance is required, okay? So upfront mortgage insurance premiums is a one-time payment paid at closing, or the cost can be financed into the loan. It's applied regardless of the term or LTV, okay? And then that annual mortgage insurance premium is applied when a mortgage is taken out, and the length is determined by the base loan amount, okay? And it can actually be cheaper than conventional PMI. But on an FHA, the mortgage insurance doesn't come off. Flavia asked a question. If you get down payment assistance and it hits the 20% mark, are you still required to get PMI? So on a conventional loan, because that's a conventional loan. So conventional loan has PMI, an FHA has AMI. AMI does not go away. Annual mortgage, can you guys see that? Oh no, the thing is in the way. The annual mortgage insurance on an FHA does not go away. It's there forever. That's why it's annual, right? And the PMI, private mortgage insurance on a conventional loan, you can pay that off. Or you can pay it upfront. So the down payment assistance does not have anything to do with your PMI. The down payment assistance is literally to cover the down payment of your property. Or if you have closing assistance, closing cost assistance, it is put towards your closing cost assistance, okay? So that's all the funds can be used for, is what I'm saying. Like exactly what they're labeled as is the only thing that they can be used towards. It can't be used towards your PMI. But I mean, if you get 100% of your down payment or closing costs covered by mortgage, the grants and the down payment programs, and then you're like, look, I'm gonna take my cash and be like, can we not do this PMI on this conventional loan? Yes, absolutely. Absolutely. But remember what I said, you have to have paid something towards the house for the transaction to be considered legal. So if you have too much assistance, they can't take all the assistance. They actually force you to pay something. So if you want to pay something, say, hey, okay, this is towards the transaction, but I also want to put this towards paying off my PMI. But if you're doing an FHA, you're going to have AMI forever, like as long as you have that loan. Thumbs up and let me know if that answered your question clearly. Inlay chats. But as you do that, I'm going to continue. Oop, I'm still in the way. Hold on. All right. Now, this loan for an FHA, you can have a non-occupying co-borrower. So if you are not going to, if your credit is not good, if you're not going to have enough for the down payment, if you don't make enough income, there's no like income requirement per se. You just have to make sure that you can cover the loan, right? But if you can't cover the loan for whatever property you're trying to get, then that's where you can have a non-occupying co-borrower. So let's say your parent wants to go in on the loan with you, but they don't want to live in this property with you. They can with an FHA loan. They can't with a conventional. They can with an FHA, okay? And you are required to occupy this property for at least 1 year. So 12 months and a day, you are required to occupy this home for that FHA. And you must move in within 60 days. So within 2 months, you need to be inside of this property or they come in for their loan. Okay? All right. Thumbs up. Got it in the chat because we got like 2 more loans and it's already 6:18. So y'all got it? Y'all got it in the chat? Let me know. Let me zoom in while y'all telling me. Okay, Christy said got it. Let me zoom in a little bit more. Now, VA, I'm going to run through really quick because unless any of you guys are there any, okay, Flavia said got it. Jenny said got it. Okay, so none of you guys are veterans, right? Because I'm about to run through this one really quick. For any veteran who is watching this replay, you guys have a lot of resources at your disposal. So please talk to your unit so that they can help you out, or talk to the Veteran Affairs so that they can help you out with any questions that you have regarding the VA loan. But I'm going to run through this really quick just in case someone actually knows a veteran and they don't know that they have this benefit, because some people just don't pay attention. So none of you guys are though, right? I don't think so. I'm assuming though. All right. So for a VA loan, there are no employment history requirements. There's no income limit. Your residual income is scrutinized. Okay. So they will look at how much you are making residually. All right. There is a 41% DTI, back end only, 41% DTI. Christy said spouse is a veteran. Oh, Christy, I can't wait to talk to you, girl. Ooh, goosebumps. I can't wait to reschedule your daggone wallet wellness exam. Please, I need to talk to you like right now. Okay? Like right now, you know how much fun stuff you can do? My brother is a veteran and he has two townhouses, new construction. They're freaking beautiful. Okay. He's in Maryland, but they're freaking beautiful. Okay. So we need to chat, ma'am. All right. Look. She laughing at me. I'm serious. Okay. All right. 41% DTI back and only, no minimum credit score required. No minimum credit score required. You can get a VA loan 2 years from discharge from a Chapter 7 bankruptcy, 1 year from filing a Chapter 13 bankruptcy, 2 years from a foreclosure, 2 years from a short sale. They don't care about your pity. That actually sounds pretty funny. They don't care about your pity. No pity requirement, no down payment, 0% down payment, okay? You can get gifts, but it's only allowed if you opt for a down payment. I wouldn't do that because that doesn't make any sense. But if you want somebody to give you some money towards that house, then I guess you would opt for a down payment for some odd reason. 4% max seller's concession. 4% max seller's concession. So you may want a gift because it's 0% down payment, but you still have to cover the closing costs. So you may need something to cover the closing costs if you don't have it. But listen, if you ain't paying for the down payment, I mean, the closing costs can't be that much. It just can't. Okay? 4% max seller's concession, 100% loan to value. They are going to cover 100% of this loan. 100%. That's why you don't have a down payment. Appraisal is required. There is, and there's some extra terminology for VA loans. So this may be a little confusing for you guys who are not veterans, but Christy, listen up, okay? So appraisal is required and you need a notice of value. You need a notice of value, okay? There's no loan limit, but $144,000 is the assumable liability limit. Okay? So if it goes over that, they're not able to assume it. Okay? $144,000 assumable liability limit. It is an assumable loan. You can assume a veteran loan. Okay, co-borrower is not necessary because you ain't really got to pay for nothing here. You good. You do have to pay what is called a VA funding fee. Okay, so you have to pay something called a VA funding fee, which takes the place basically of the mortgage insurance and the PMI. Okay, which is the other PMI and AMI. Okay, owner occupancy is required. Okay, for full length of the loan and must move in within 60 days. Now, this was pre-pandemic. After the pandemic, the VA loan actually shifted. You are now able to have a home, and I don't know the specific length of time that you have to stay in the property, but you can now have multiple VA loans where pre-pandemic you could only hold one because of this requirement. But they removed that requirement. So now you can have multiple VA loans, you can have multiple properties under your VA loans and skip to your loo all to your heart's content, as long as you can obviously afford it. I just gave y'all a gem and you didn't even realize it, Christy. You could go get the rental income profit producing property with the VA loan and then turn around and get your primary home with the same loan and not have to pay nothing for it, basically. I'm just saying. Type got it in the chat if you got it. Now, here's a couple of specifications. So specifically for veterans of the U.S. Armed Forces and their surviving spouses, okay? The VA guarantees the lender $36,000 or up to 25% of the loan value, whichever is less, to the lender should a borrower default on their loan. It can only be used for the veteran's primary residence, but now after pandemic times, you can actually use it for whatever you feel. Certificate of eligibility. You must be honorably discharged or discharged due to hardship, convenience of the government, reduction in force, certain medical conditions, or a service-connected disability. Okay? And you must meet certain service requirements. Now that we are not privy to, that is up to the VA. Okay? All right, I'm going to skip through this stuff. I will add the rest of this information because this presentation is going to be available to VIPs. So the rest of the information for the VA loan will be in there. Chrissy said, is VA available for, no commercial properties. This is residential only. Residential only. No commercial, residential only. All of these loans are residential loans, not commercial loans. Okay. Now, the last one that I really wanted to talk to you guys about, which is super cool, is the USDA loan. So this is the U.S. Department of Agricultural loan. It is available in rural areas of less than 35,000 people. Available in rural areas of less than 35,000 people. Now, does that say that it has to be a farm? No. Does that say that it can't be a town? No. Does that say that it can't be a city? No. It just says rural area, well, city, no. But rural areas of less than 35,000 people. Now, you could start off with it being a rural area and then you develop it and now it's a city. It won't qualify for USDA for anyone after that. But that is what a lot of investors have done. They've gone into USDA areas, built them up, and then they don't qualify anymore, but they already got the benefit. Okay? So with a USDA loan, no employment history is required. No employment history is required. 115% income max of the area median. Okay? You're going to need a 29 or 41% DTI. The 29% is front end. The 41% is back end. So anytime I said slash, it's front end, back end. Okay. No minimum credit score is required. No minimum credit score. Anyone can get a USDA. No minimum credit score is required. You can get it 3 years from a discharge of a Chapter 7 bankruptcy, 1 year from filing a Chapter 13 bankruptcy, 3 years from a foreclosure, 4 years from a short sale. They don't give a crap about your pity. Okay? No pity requirement. No down payment requirement. You can do gifts, but it is only allowed if you do a down payment. There is no restriction on a seller's concession, which means sellers, lenders, realtors can give you whatever they need to get you to the closing table. 100% loan to value, which means that they are paying 100% for that property or for that land. So for those of you who want to buy land, you obviously can do it with a USDA loan because they're the U.S. Department of Agriculture and they want you to buy it. Okay? An appraisal is not required. An appraisal is not required. So you could be like, yo, everywhere else they selling it for this amount. This is the amount I want it for. USDA, give me my money. All right? No loan limit. There is no loan limit, and these people are going to pay 100% of whatever the value of that property is. Do you guys hear me? Are you listening? This loan, unfortunately, is not assumable, so you cannot assume this loan. There are no additional mortgage fees, so no PMI, AMI, funding fee, none of that fancy stuff. A co-borrower is obviously not necessary because they're going to approve you irregardless. And there is no owner occupancy requirement. I'm going to repeat that. There is no owner occupancy requirement. You don't have to live there. I'm just saying. I am just saying. Okay? USDA can offer a direct loan to low or very low income applicants. Okay, USDA provides 90% loan note guarantee to approved lenders. Initial guarantee fee is 1% and monthly guarantee is 0.35%. Initial guarantee fee can be added to the loan amount, okay? Funds often run out by September. So like around now, most of the USDA funding has ran out. So you're going to want to do this in the beginning of the year, in the middle of the year, but don't wait until the end of the year, which is the difference between going after any of the other loans, because with a conventional FHA and a VA loan, all of these types of properties that will qualify for those loans would be on sale at the end of the year, because most people don't want to move during the cold season. Now, obviously, if it's Florida, they don't give a rat's crap because it's hot here all the time. But in places like New York, New Jersey, Maryland, right? All of the other loans, you're going to want to get them towards the end of the year because houses and buildings will be on sale. Those sellers will be so upset because no one is going to want to move in the middle of the freaking winter or the rainy season. Oh, that's a good point. So if it's like a warm place, if it's the rainy season or the hurricane season, that's probably the equivalent to during the winter and fall seasons in other states. Okay, USDA, it don't matter. Go get your property anytime. Okay, but make sure that you get it before September. All right. Jenny said, "Wow, it's excellent." Chrissy said, "Nice." Chrissy said, "Boom, baby." Exactly. Okay, so we're going to close this out. What if you have less than perfect credit, less than 2 years job history, non-traditional types of income, higher DTI, or loan amounts that exceed the loan amounts that were provided, okay? So this will be considered a conventional non-conforming loan, and this is what Christy was kind of asking me earlier. So a jumbo loan, which is a single family loan that exceeds Fannie Mae and Freddie Mac's loan limits, or subprime mortgages. Okay, this was designed for borrowers who have credit scores in the 500s. But Freddie and Fannie loan limits change annually. So if you're not ready to purchase this year, check again to see if the loan you would have received that year. Okay, can buy, blah, 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 blah. All right, so subprime loans are one of the main causes of the mortgage crisis of 2008 and 2009. They were manually underwritten. There was little to no amortization or exclusively negative amortization, little to no verification of income, assets, or employment, and they had much higher interest rates. So if you ask this question, know that no lender is going to risk their license to give you a house you've proven you cannot afford. The strict rules have been put in place to help, not to harm. We tried it that way, and it led to the biggest crash in the economy we'd seen since the Great Depression. So please stop asking if you can get it with bad credit, okay? Or no money. Stop doing that. You are doing a disservice to yourself, and you're putting that lender at risk for losing their livelihood, and it's not fair, okay? Just get yourself in order and then go get the loan. Where can you borrow? And I have to speed through because I gotta go, guys. I'll take the questions tomorrow, I promise. So where can I borrow, right, to buy? You can borrow in the contiguous USA, the 48 states that actually touch each other, okay? The District of Columbia, located in Washington, capital of the US. You can buy or you can borrow in Alaska, okay, which is the borders the Canadian province of British Columbia, and you can actually borrow in some islands. So you can borrow in Puerto Rico, you can borrow in Hawaii, you can borrow in Guam, and you can borrow in the U.S. Virgin Islands, St. Croix, St. John, and St. Thomas. So if you don't want to stay here in the States, you ain't gotta. Okay? That is a myth. All right? This is where each and every one of those loans qualify for. All right? Super cool, right? So if you want to go to Hawaii, you can go to Hawaii with one of these loans. If you want to go to Puerto Rico, you can get an FHA loan in Puerto Rico. You picking up what I'm putting down? You're picking up what I'm putting down.